You worked late for a month, hit your number, and the email arrived, a $5,000 bonus. But the next Friday, when you opened your bank app expecting something close to $4,000 to land, $3,200 showed up instead. You did the math in your head. $1,800 missing, a 36% hit. That is higher than your salary tax, and higher than the top bracket most people you know are even in. The internet, the group chat, and the coworker in the next cubicle all say the exact same thing to explain it. Bonuses get taxed harder. The government punishes irregular income by tossing it into a separate, brutal tax bracket. Here is the truth. There is no such thing as a bonus tax bracket. There is no separate IRS schedule for bonuses, and the tax code literally has no mechanism to single out a bonus for punishment. That $1,800 is not a tax. What feels like a penalty rate on payday is the result of confusing two distinct financial concepts: withholding and tax. Your employer's payroll software isn't stealing from you, it just isn't explaining itself. Once you translate what is actually happening behind the scenes, you stop being angry about the wrong thing, and you realize most of that money is coming back. Let's look at what actually happens on payday. When the IRS classifies the money your employer just handed you, salary and bonuses live in two completely different buckets. Your regular paycheck is regular wages. Your bonus is what the IRS calls supplemental wages. This diagram shows exactly how that supplemental bucket is handled. Employers don't know your final annual tax rate. They don't know if your spouse got a new job or if you had a kid, so they have to guess. The IRS tells them to use a single flat default rate, 22%. On a $5,000 bonus, $1,100 gets sliced off and sent to the federal government. Then comes the second layer. FICA is the mandatory payroll tax that funds Social Security and Medicare. It takes exactly 7.65% out of every dollar you earn, whether it's hourly, salary, or bonus. That pulls another $383. Finally, there is state withholding. Depending on your geography, this changes drastically. If you live in Texas or Florida, your state takes nothing. If you live in New York or California, you might lose an additional 6 to 10%. Add the federal flat rate, FICA, and an average state tax together, and there is your missing money. That is the 36% gap you saw on your phone. Think of this entire process like going out to dinner with 7 friends. Instead of calculating the exact math at the end of the meal, the server says the bill will be around $600, so everybody throw $80 in the pot right now as a deposit, and we will sort it out later. That $80 is withholding. It is a mandatory prepay. The 36% hit on your pay stub was exclusively a localized estimated guess for one single paycheck, not your actual tax rate. The second timeline arrives on April 15th. This is tax day, the moment the initial guess is finally compared against your actual bill. This graphic shows what the IRS does next. The supplemental distinction completely vanishes. Your bonus is poured directly into the exact same bucket as your regular salary and any interest income, stacking together into one single unified total. That combined yearly income is what gets measured against the standard marginal tax brackets, 10% at the bottom, then 12, 22, 24, and so on. Every dollar you earned flows through those exact same tiers. Here is where the math corrects itself. Let's say your total combined income places your highest marginal rate at 12%. Your employer withheld your bonus at 22%. The IRS overcharged you by 10% of $5,000. That $500 simply detaches from the government side, returning to you. On tax day, your bonus is taxed identically to a standard salary raise. The system is perfectly self-correcting. Your missing money isn't gone. The overpayment simply becomes your spring refund. Now, the lag is real. A bonus paid in March and reconciled the following April means you just gave the United States Treasury an interest-free loan for a year. In a high-yield savings account, you are losing out on a couple $100s of actual interest. If financing the federal government for free bothers you, you have a lever. By filing an updated W-4 form with your employer, you can intentionally lower your total yearly withholding. You effectively convert that distant spring refund into a slightly fatter monthly cash flow right now. Even when you know the math, the initial drop still stings. Behavioral finance researchers call this the reference point effect. You saw the $5,000 gross number in an email, your brain anchored on it as yours, and the net deposit instantly felt like a massive loss. A loss hurts more than an equivalent gain feels good. The psychological pain is completely valid, but the math is sound. Your bonus was not robbed, punished, or thrown into a secret tax bracket. It was simply over-withheld. Knowing the difference between the guess and the bill is what finally gives you control over your money.